What if you live to 95? If you retire today at 65, there is a meaningful possibility that you'll live well into your 90s. And that means retirement's going to last 25 to 30 years, sometimes even more. That's longer than a lot of people's careers in total. When your timeline stretches that far, your biggest risk isn't one bad market year. It's running out of time-adjusted purchasing power. Is your plan built for decades or just the first 10 years? Do you know how much of your paycheck Social Security will replace? For the average worker, it replaces 40% of your pre-retirement income. It was built as a foundation, not an entire income solution. That means roughly 60% of your lifestyle must come from somewhere else. And if your retirement math assumes that Social Security is going to be covering more than that, then the gap can show up quickly. What's covering the other 60%? Would you turn down an 8% raise? If you delay Social Security past full retirement age, your benefit will increase 8% per year until age 70. That increase is built into the system, and for healthy individuals and married couples, that decision can significantly increase lifetime income security. Timing your claim is not emotional, it's mathematical. Are you optimizing your lifetime income? Or just starting early? Here is something most retirees underestimate. RMDs begin at age 73 on most accounts. Even if you don't need the money, you still need to take it out and pay taxes on it. Those withdrawals can increase taxable income and affect Medicare premiums. Have you planned for the tax wave before it becomes mandatory? Most people assume Social Security is tax-free. It's not. Up to 85% of Social Security benefits can be subject to federal income tax depending on your total income. When withdrawals and investment income stack together, taxation becomes part of retirement planning. Have you looked into your retirement income after taxes?
Inflation does not feel dangerous year to year. Historically, it's gone up just under 3% annually. But over 20 to 25 years, that can cut purchasing power in half. In a 30-year retirement, that erosion compounds significantly, and if your portfolio is only set for stability, what happens in year 25? Have you budgeted for healthcare in retirement? Because Fidelity estimates a 65-year-old couple may need up to $300,000 for healthcare expenses in retirement. That figure doesn't even include long-term care costs. Healthcare shouldn't be a surprise category. It's a structural expense. Is that number in your plan? Did you know that early retirement years matter more than later ones? If markets decline early while you're withdrawing income, then the long-term sustainability of your entire portfolio can be permanently affected. This is known as sequence of returns risk. The average return over 20 years might be fine, but the order of returns changes outcomes. Has your plan been tested for a bad start? You've probably heard of the 4% rule. It was built using historical simulations under specific assumptions. It is not a guarantee of future results because market conditions, interest rates, and longevity can all change sustainability math. Are you using a shortcut or a strategy? When you look at your 401k, are you thinking pre-tax or after-tax? A large number of most people's wealth is in a pre-tax retirement account. That means taxes are still going to be owed on your withdrawals, and your account balance might not equal your spendable balance. Have you calculated your true after-tax retirement number? What if you don't get to choose your retirement date? Surveys show that many retirees will leave work earlier than planned due to health or job changes. Retirement is not always a perfectly timed decision. Plans that rely on working longer may unravel more quickly. Would your plan still hold if retirement started tomorrow? Most people think that Medicare handles long-term care, but it does not cover most custodial long-term care expenses, and extended care often requires personal savings or separate planning. That late life risk can be substantial. Is that accounted for in your projections? People love quoting returns, but the market does not usually move in a straight line. Some years can be strongly positive and others can be sharply negative. In retirement, volatility matters more than the long-term average because withdrawals can be happening at the same time. Is your plan built for averages or reality? Here is a fact most people ignore. Higher income individuals tend to live longer than lower income individuals, and that means that a wealthier household may face longer retirement timelines. So, planning off national averages may underestimate your actual longevity. And if you built wealth, are you planning for extra years? Do you expect to spend the same amount every year in retirement? Research shows that many retirees will spend more in early retirement and less later on, with travel and discretionary expenses declining over the years. Withdrawal strategies should reflect real spending patterns. So does your plan assume a straight line? Cash feels safe, but inflation quietly erodes its value over time. Holding too much cash in a long retirement can reduce purchasing power significantly. Stability in the short term does not equal durability in the long term. Safe from volatility, but not safe from inflation. Many retirees rely on dividend income, but dividends can be reduced or suspended during times of economic stress. Dividend-paying stocks are still stocks, and income strategies should not be dependent on one single mechanism. Is your income diversified? This one surprises people. Research shows that many retirees maintain or even grow their net worth throughout retirement because they underspend relative to portfolio growth. Fear of running out often causes unnecessary restriction, and that means people will sacrifice lifestyle without really needing to. Is your plan built only to survive or to let you live?